All right, it looks like it's about 9:31, so I'm going to go ahead and get started. Thank you, everybody who was able to join this morning. We truly appreciate your business. And again, this is Pat Swain from the Thompson Agency. Today, we're going to be discussing two different life sales concepts. This is somewhat carrier specific. Comes from American General, one of our carrier partners. And I thought this was um, an interesting strategy to go over in that it's very unique in their product. And so again, I hope that some of you can think of clients that could fall into where this product fits your clients' needs, and certainly come to us with any cases that would fit the profile. So again, thank you for joining. All right, so let's go ahead and get started. So there's actually going to be two strategies that I'm going over this morning. The first one is specifically asking your client income, guarantees, or both. What does your client need most? More potential income or more guarantees? Certainly, we see a lot of guaranteed UL still being sold. The issue with guaranteed UL is that it continues to go up in price, due to low interest rates. And there's not a whole lot of frills beyond that. There's no cash value most of the time. Sometimes you can add a chronic illness, long-term care rider for flexibility, but really that's it. So there's not a whole lot that you can do with it. And if the client can't pay the premium, they're kind of out of luck. So there's no surrender value, and there's nothing that they can gain from surrendering the policy. So with this American General product, this Secure Guaranteed UL, I'll be showing how we can use it in combination with an accumulation IUL for your client. So again, the question here is income, guarantees, or both. What do your clients need most? So let's look at some background information for this concept. So for long-term, life insurance needs, there's a variety of permanent insurance options. As I mentioned, guaranteed UL, index UL, current assumption, and interest-sensitive UL, which really isn't that popular anymore just due to low interest rates staying where they've been for so long, or whole life, for that client who values guaranteed death benefit and guaranteed cash value and doesn't mind paying a little bit more in premium. So those are your options. So some focus on guaranteeing that insurance coverage is there when it's needed, while others provide the potential for tax advantage cash benefits, which may be used to supplement retirement income. So the question is, what is best for your clients? And I think when we go over these two solutions, it will hopefully open up your mind to combining different product solutions versus just looking at one. So here's the case study that I wanted to go over. We have Grant, a 45-year-old pediatrician, married with 3 kids, and he needs $500,000 of additional coverage. So his investments suffered in a recent recession, and he wants to ensure his family's long-term protection. So he likes the long-term guarantees in a guaranteed UL policy, but again, there's no real cash value for income. He also likes the potential for supplemental retirement income from an index UL. But of course, the drawback there is there's fewer guarantees than in a guaranteed UL. So in Grant's case, we've determined that he's willing to contribute $9,700 a year for the next 20 years till age 65 for that additional coverage need, as well as potentially some retirement income. So again, he's looking to accomplish both those goals. So let's look at some solutions. Let's review some of these solutions. For $9,700 a year, Grant's financial professional offers him 2 interesting options. Solution 1 is just going to emphasize income potential. So we're going to buy him a $500,000 max accumulator IUL, and this is going to take advantage of current markets for growth potential. So with the IUL, again, the big selling point there is you're getting a floor. With the American General's product, a 0% floor, and the cap, again, the cap fluctuates. It can be anywhere from 9 to 13% with most carriers. I believe with American General's, it's at 10% currently. So built the correct way, $500,000 face, $9,700 to going in for 20 years till age 65, we're going to be able to illustrate a $26,000 tax-free income stream from age 66 through age 85, assuming a 6% rate of return. So we're not illustrating the max rate of return, but something kind of in the middle, not overly aggressive nor too conservative. So it's attractive to the extent there's potential there. But again, he has to depend upon performance, and there's no guarantees there. And his guaranteed coverage ends at retirement. The issue anytime you illustrate an IUL is that when you look in the guaranteed ledger, it's going to assume guaranteed cost of insurance, and that's really the kiss of death for any performance-driven UL or IUL. That's the trade-off. It's going to illustrate really well on the current side, but if for some reason, carriers continually increase COIs, you're going to have an issue illustrating on that guaranteed side. So let's look at solution 2, and I think this is where, this is the interesting part of the strategy. Then this is combining two different products. So instead of just doing that $500,000 max accumulator IUL, we're going to do a $250,000 max accumulator IUL and a $250,000 secure lifetime guaranteed UL. So with that strategy, now we're going to be able to illustrate $19,000 of tax-free income on the IUL from age 66 to 85. So a bit of a dip, in the respect that we do have to put some of that premium into the secure lifetime GUL. But again, he's still getting $19,000, and that guaranteed UL is going to provide guaranteed death benefit protection until age 95. The big selling point here is that on the guaranteed UL, and this is the uniqueness of AIG's secure guaranteed UL, is that you can accelerate the death benefit for income. It's not a chronic illness acceleration, and this rider is called the Lifestyle Income Solution Rider. So after you end up paying the policy up, again, we're using a 20-pay premium. We're going to wait 10 years, and at age 86, we're going to start that income from age 86 through 95, where the client can take out $19,000 a year, still tax-free. And the death benefit's still guaranteed through age 95. So now you're getting a 30-year income stream. The total cumulative income is actually more, and you're able to guarantee coverage to age 95. So again, that's the uniqueness of the secure guaranteed UL. Again, it's not based on performance, just it's based on accelerating the death benefit, and there's no conditions that have to be met, like with a chronic illness rider. And forgive me, there is one condition that has to be met. The policy has to stay in force for at least 15 years before you can start this income stream. It's really a built-in annuity based on the death benefit. So let's compare the solutions side by side. So again, we have $9,700 going in for 20 years. That's $194,000 of total premium, both solutions. With solution 1, we're getting out $26,000 a year for 20 years. That's $520,000 of tax-free income. Remember, that's only coming out of the IUL. One product solution there, not guaranteed, based on a 6% rate of return. Solution 2, we have the $250,000 accumulator IUL and a $250,000 secure guaranteed UL. $19,000 a year from age 66 through age 85, and an additional $19,000 from 86 through 95 guaranteed. So the first $19,000 for the 20 years is still based on performance, but on the back end, you're going to get a guaranteed income stream produced from that lifestyle income rider. Excuse me. So again, that's the uniqueness of that solution, and no other carrier has that type of product feature on a guaranteed UL. So AIG is unique in that respect. And let's look at it from a death benefit perspective. You can see the blue is the solution number 1 with just the IUL. Your guarantee basically goes away right after retirement age. You can see at age 66, it's still there, and then it's gone. Again, you're not buying an IUL for guarantees. If you were paying for guarantees, your income would suffer. So you're basing on the fact that the S&P is going to do well, and the carrier is going to maintain current cost of insurance. With solution 2, you can see you're going to have a guaranteed death benefit all the way through age 95. Now, granted, if you choose to use that income, an acceleration of the death benefit, it's going to reduce your death benefit. And it's not dollar for dollar. It is more than that. So, it's not a too good to be true scenario here. It's based on mortality and interest. So it does get reduced more than dollar for dollar. But again, it's guaranteed income and it's tax-free. So those are your huge selling points there. So to summarize this first strategy, Grant wanted the most out of his insurance program, but he had concerns about guaranteeing his family the protection they deserve. So he wanted those guarantees, and the financial professional smartly gave him 2 options. Now, it's not always about making suggestions. It's about offering solutions and letting the client make an educated decision. So in this case, he offered him the IUL for maximizing potential supplemental income. And then 2, kind of the best of both worlds, lower income potential in the front end at least. Long term, obviously the cumulative income was a little bit more, but with stronger death benefit and income guarantees. Remember, it's just not death benefit guarantees, it's also income guarantees. That's a built-in annuity based on the face amount. So which one do you think he chose? Remember, he was looking for some guarantees because he wanted that additional protection for his family. Well, I would say definitely solution 2. So that was strategy number 1. Let's look at strategy number 2, and this really applies to the title of this webinar called the 10-10-10 plan. So the question is, with this strategy, what if you could knock out 3 birds with 1 stone? So one policy that can help with life insurance coverage, chronic illness coverage, and retirement income. So we call this strategy the 10-10-10 plan. So the one thing to take note of here is that the death benefit coverage will be guaranteed to a max of age 100. You can potentially provide a chronic illness benefit. And in this case, in this particular strategy, you're going to pay premiums for 10 years, wait for 10 years, and get your money back over 10 years as a supplemental retirement benefit. So that's, high level, that's what you're going to be presenting with this plan. Let's look into the specifics. So certainly while term insurance is, the most popular form of life insurance, because it's inexpensive, it only provides temporary coverage. We always say, do you want to rent insurance or do you want to buy it? Do you want to own it rather? So for longer term permanent needs, there are a variety of choices that I mentioned earlier. GUL, whole life, IUL, current assumption UL. But one of the most secure and economical options being guaranteed universal life, it's usually a no-frills policy, offering very little benefits beyond just the guaranteed death benefits. I almost call it it's a long-term term policy. It's a guaranteed term for your lifetime. So what you're going to be able to offer here is this secure lifetime guaranteed UL that provides innovative extra features. So let's look at a hypothetical example. Here we have George, who is 50 years old, and he's looking for $1 million of coverage for his family. He wants to provide life insurance for his spouse well into retirement, but sees that need dropping as he approaches latter retirement years. So this is very common. Unless somebody has an estate planning or wealth transfer issue they're looking to take care of, most people are going to have that higher need during those working years up through retirement, till retirement, and then that need is going to slowly evaporate. But they still might want to keep a decent amount of coverage on the back end as well. Certainly not the same amount that they did during their working years, though. He's also concerned about the impact of a chronic illness on his retirement. So if George has built up a lot of assets, he doesn't want to use a large portion of those assets for long-term care, chronic illness need. Going into assisted living, going into a nursing home. We know how much those things cost. And so to deplete those assets that he worked so hard for, that's really going to hit a nerve if you mention that to your client. So in George's case, he's willing to pay $24,000 a year for 10 years. And in this strategy, then he's going to pay nothing for 10 years. So there's our 10-10. And on the last part of this, the 10-10-10, he's going to take out $24,000 out of the policy for the last 10 years. So pay for 10 years, wait 10 years, pay nothing, and then take out for 10 years. Take out your premium. Now, you could take out more, as we illustrated on the previous strategy, but you could choose to just show him getting back his premiums tax-free. And this, again, is using that lifestyle income solution rider. So that's pretty cool to mention to your client. You're paying your premium. You do have to wait, additional 10 years to make this work. And again, it's going to vary by the age of the client too. It's not going to be perfect in every solution. You might have to wait a little longer, or maybe you can do it by year 15. But in this case, he's able to do it in year 20. Years 21 through 30. And he's going to get back all the premiums he paid in tax-free and still have his life insurance coverage guaranteed through age 100. Now, remember, when you take out that money, that $240,000, it's not going to reduce dollar for dollar. It's more than that. But he's still able to maintain a death benefit of $420,000. So pretty cool. He pays in that premium, he gets it back, and he still has a guaranteed death benefit of $420,000. So not counting the cost, the time cost of money, time value of money, his net outlay is zero. So $1 million to age 70, then it steps down to $420,000 by age 80, and that's guaranteed to age 100 while he got back his premiums on a guaranteed basis, mind you. So once you show this on the front end, by year 20, you don't have to worry about, we got to look to make sure it performed well. There's none of those variables that you have to concern yourself with that you have to do in an index UL or a VUL sale. Once you pay that premium, once you tell him, hey, as long as you pay this premium on time each year, you're going to have the potential to take those premiums back from years 21 through 30 and still have a guaranteed death benefit through age 100. That's it. The plan is in place, and there's no variables that can mess that up for your client. The other thing is, if you remember, George was also concerned with having a chronic illness acceleration available. So he added that onto the policy as well. So not only the lifestyle income rider, but also AIG's chronic illness rider. So you can choose a 2% acceleration. They also have a 4% option, as well as a per diem. So the per diem is cool because, it starts off at a certain amount. I think it's $360 daily. And whatever that grows to, it can continually go up on your policy. So he chose the 2%. So you start at $20,000 monthly that could be accelerated. But remember, once that death benefit goes down to $420,000, your chronic illness acceleration will also drop down to $8,400. But that's also guaranteed. So everything about this is guaranteed. And you have so much flexibility. It could be based on a chronic illness need. It could be based on wanting to get back your premiums. But you can put all these features on the policy on the front end and not have to make those decisions right away. It's just going to create more flexibility for your client. So that's the 10-10-10 plan. Again, it's on American General's Secure Guaranteed UL. And again, to recap, you have the first strategy, taking a look at combining accumulation products with guaranteed products. And in this particular case, a guaranteed product with that lifestyle income protection rider. And also the 10-10-10 plan. Pay in for 10 years, wait 10 years, and accelerate. Could be premiums paid, could be a little bit more, could be a little bit less. There's flexibility there for 10 years. And still provide a guaranteed death benefit through age 100. So unique solutions here. And we're happy to entertain any cases that you come across where you might think this is applicable. But again, I appreciate everybody joining the call this morning. And again, we will be having this call again, the first Wednesday of every month. And this call will be recorded and put on our website. So hope everybody has a great day. We'll talk to you soon.
Take care.